Specifically, I believe the US dollar will lose 75% of its absolute purchasing power over 10 years. Does gold need to move immediately? No. But over 10 years, what moves the gold price is people's concern about the maintenance of purchasing power in fiat-denominated instruments. And those fears are very real. Specifically, I would suggest to you that probably 85% of the listed junior miners worldwide are valueless. We have been underinvesting in copper for 3 decades. There is no way that we're going to make up for 3 decades of underinvestment in 5 years or 10 years in capital-intensive cyclical businesses. If you are a contrarian, you're going to be a victim. I like to describe myself as a guy who buys hate and sells love.
Hello, everyone, and welcome back to another episode of Verified Market Insiders. I am Everett Millman, the senior editor here at Verified Investing, and my guest today is truly one of the legends in the world of commodities and mining. Rick Rule is the president and CEO of Rule Investment Media, and he is a renowned investor and speculator with a focus on natural resource industries. Over the past 3 decades, he has led hundreds of privately placed equity issuances for resource companies across 6 different continents. So, Rick, thank you so much for joining us today.
Pleasure to be with you. Thank you for having me.
All right, so let's jump right in. What is something going on in the natural resource sector right now that you think either investors may be making too big of a deal of or what they're kind of missing entirely?
Well, I guess the big noise in the natural resource business is the war in the Persian Gulf. That's had dramatic impact on the oil price. People don't realize that the Persian Gulf is also important for liquefied natural gas, sulfur, sulfuric acid, helium, aluminum. Whether they're making too big a deal about it or not a big enough deal at all really depends on how the war goes. And I need to say, I'm a credit analyst, not a military or political analyst. But clearly the big news is the Gulf.
Right, right. And I appreciate again the humility of, kind of knowing your lane and your space. We will get back to what's going on with oil, but one of the big stories in 2026 is obviously gold. Gold has had a remarkable run. And from your vantage point as someone who's operated in this space through multiple different market cycles, do you see this as a structural change for gold, or are we beginning to get into territory where a lot of this has already been priced in?
Yes and yes. In the near term, it's priced in. The price escalation that we saw in the period 2024 and 2025, while dramatic, I think was rear looking. I think you could describe the gold market in 2022 as a coiled spring with lots and lots and lots of tension. That tension got released and the gold price moved from 2,000 to $5,000. Does it need to go up more now? No. But over 10 years, what moves the gold price is people's concern about the maintenance of purchasing power in fiat-denominated instruments. And those fears are very real. Specifically, I believe the US dollar will lose 75% of its absolute purchasing power over 10 years, just like it did in the 1970s. For those of you who remember the 1970s, that was concurrently a very, very, very good time for gold. Does gold need to move immediately? No, it has. Will gold do well over a decade as the dollar loses purchasing power? Yes, both are true.
Wow. So with that in mind, de-dollarization has been a major talking point. We see central banks not only buying gold and adding to their gold reserves at a pace we have not seen in decades, but then there's also like BRICS and other countries are exploring alternatives to dollar-denominated trade. And your point comparing, fiat instruments to gold is well taken. That would apply to any currency, fiat currency. But does the de-dollarization trend does it affect your thesis on gold and the outlook for the US dollar in any really meaningful way?
Unusually in my sector, the answer to that is no. While I believe that the US dollar will do absolutely poorly, I think it will do relatively well. My friend Doug Casey says that the US dollar is the worst currency in the world with the sole exception of all of the others. I continue to believe that. I believe that the ills that plague the United States to a greater or lesser degree plague all of the other governments too. And the consequence of that is that the whole complex of fiat currencies and debt-denominated instruments will have a fairly tough decade. I believe that gold will maintain its purchasing power. If you maintain your purchasing power in a world where the currencies are losing 75% of their purchasing power, the nominal price of gold, which is to say the price of gold in US dollars or renminbi, or British pounds or euros, I think does fairly well. With regards to the BRICS common currency, these aren't convertible currencies. These aren't currencies that have a lot of debt denominated in them, leading to purchases for repayment. They are not transparent societies. They aren't the
Mm.
type societies that one can build credit default swaps around. So I think relative to other fiat currencies, the US dollar will do fine. I think the relative purchasing power of the US dollar will decline precipitously, very much like it did in the 1970s.
I appreciate that nuance. I've heard, the US dollar referred to as the cleanest shirt in the dirty laundry. That kind of lines up with what you're saying. I also want to focus on junior mining stocks. You have been in the junior mining space for decades, and we're talking about sub-billion-dollar market cap companies. For someone like a retail investor who's never navigated that market, what is the most important difference they need to understand between a junior or mid-tier miner and one of the large cap majors like a Newmont or something?
Well, the first thing before investing in the sector is to invest in yourself and learn. This is a truly treacherous place. But people do it because a few of us have made so much money at it. You will note, however, that the tactics that I employ are tactics that I learned in a career beginning in 1974, which is to say 52 years in the space. I got a lot of scars that you can't see, and I'd prefer that you didn't incur them. Specifically, I would suggest to you that probably 85% of the listed junior miners worldwide are valueless. That is to say, they are worth nothing. That disguises the fact that 10 or 15% of the issuers generate so much performance that they add legitimacy and luster, sometimes, to a sector where 85% of the population is valueless. If you are willing to do the work, really truly willing to do the work, to learn to separate the good, the bad from the ugly in movie parlance, you can do spectacularly well in the junior miners. But you have to be hardworking, you have to be persistent, and you have to be patient. If I might elaborate on that, you make most of your money or from a few successful efforts. When I look back at the 10 baggers or 20 baggers or even 100 baggers that I've enjoyed in my career, a few things stood out. The first is that most of those huge gains took place in positions that I held for over 5 years. The second thing is that almost every big gain I can think of caused me to experience at some point in time that I held it, a 50% share price decline, which is to say the stock went down by 50% by before it went up 1,000%. So your viewers, if they're going to participate in this space, need to work hard, they need to be patient, and they need to be tenacious. If they can't say to themselves that they're going to accomplish all three of those things, they should stick to the larger cap producers and just enjoy the beta in natural resource markets, which I think will be plenty. If they want to chase alpha, they need to understand the risks and they need to do the work.
The work that does sound treacherous, but we are very much of the same mind as far as investing in oneself for education. That's a big part of what we do here at Verified Investing. Something that I followed for quite a long time in the commodity space is this issue of resource nationalism. That governments in foreign jurisdictions, they want to get a bigger piece of the pie from multinational mining operations, and sometimes I hear that described as jurisdictional risk. How do you factor that risk into where you're willing to deploy capital?
I believe the most dangerous government is the one closest to you. In the decade of the 1970s, we had an excess profits tax in the US. That's resource nationalism. In nice, calm, polite Canada, 20 years ago in the province of Alberta, when the natural gas price rose, they doubled the severance tax and the royalty. That's resource nationalism. What happens is that you tend to discount the risks that look like you. Specifically, and I'm sorry for the hate that this will generate online, uh, people like me somehow believe that money that's stolen from them by white people in English, according to the rule of law, is less gone than than money stolen in other countries, in other languages. The worst experience that I've ever had in real dollars with political risk came in 1980 in the People's Republic of California. By contrast, the countries that I have made the most money in, not without risk, have included such garden spots as the Congo, South Sudan, Syria, and Indonesia. I would much rather have a great deposit in a country that's regarded as gamey than I would a lousy deposit in a country that's regarded often falsely as good. So yes, political risk is huge, but political risk is very, very often misidentified. So to the extent that you're going to incorporate political risk in your investment strategy, it's very important that you be self-honest with where those risks are. Are they narrative risks? Are they actual risks? And how much are you paying to experience or avoid them?
I very much like that. It's kind of holding a mirror up to any investor's thesis. So another big story in the resource space is that copper prices, they're coming off their best year in 2025 since 2009. And you brought up narratives. There are a number of different narratives swirling around this price action in copper, whether it's the tariff risk or AI data center buildouts, the green energy transition. So those are all just narratives, but from, again, your vantage point, what's the most important driver for copper prices right now?
There are two. Demographics. There are still a billion people on Earth that have no access to private electricity. We will resolve that problem in the next 20 years. Those people want to live like you, and we will afford that life to them. And that is going to take copper. Copper to generate power, copper to bring power to them, and copper to utilize the power in their homes. As the world gets richer, it gets energy denser, and the platform for that is copper. On the other side, we have been underinvesting in copper for 3 decades. There is no way that we're going to make up for 3 decades of underinvestment in 5 years or 10 years. At the London Mining Week, the end of last year, we heard from the copper industry that they need to spend $250 billion constant 2025 dollars to maintain their current levels of copper production. Two problems with that. The first is that we have a structural deficit now. So they're not going to bridge the gap. They're only going to maintain the deficit. The second thing is that they also say that copper demand is increasing at 2% compounded. So a $250 billion investment doesn't bridge the gap between supply and demand. It just keeps the gap growing in terms of current levels of consumption without factoring in a 2% compounded annual increase.
Wow,
Absent
yeah,
a
that
worldwide depression that clobbers copper demand, the production shortfalls, the difference, the delta between supply and demand can only be rationed by price in the next 5 to 10 years. There's no other way that can happen. By the way, the senior copper producers talk about the $250 billion that they need, and they say that they have line of sight to 150 billion of it, leaving them about $100 billion short. Also, the inputs in constructing a big copper mine are increasing at about 8% compounded. So when I say $250 billion, I'm talking about 250 billion constant 2025 dollars. Uh, Compound that number at 8% annually for 10 years, and you get some truly eye-popping capital cost requirements 5 years out, 7 years out, and 10 years out.
Yeah, that math is undeniable right there. Similar to what we're discussing with copper, the shortages, and resource nationalism. There's been a massive concern about critical minerals recently, like lithium, cobalt, again, copper, rare earth metals. How much of that concern do you think is actual fundamental demand versus maybe a bit of hype that's getting ahead of itself?
I think there is a fair bit of hype. You need to look at those materials separately, and you need to understand too that markets work. The cure for high prices is always high prices, and the cure for low prices ultimately is always low prices. You too need to consider that narrative in terms of your own portfolio. Very thin markets, very small markets like rare earths can explode upwards, and then they can get clobbered with the introduction of new supply. We saw that in the lithium business. So this is a very complex topic you've introduced me to. I would only say, buyer beware if you want to play this. First of all, rare earths, as an example, are not rare. They're rare because we haven't looked for them, and we haven't looked for them because the Chinese produce them so cheaply. That appears to be beginning to end for two reasons. Geopolitical reasons, where the Chinese are beginning to weaponize rare earths the same way the US weaponizes the dollar, but also because the Chinese cost advantage was due partly to mining practices that were and are environmentally very, very, very destructive. The Chinese people and the Chinese government are less tolerant of those mining practices. So one thing that isn't broadly known in the market is that the cost to produce rare earths in China has escalated by 30% in 3 years, which is to say a lot of their cost advantage is history. Uh, if you are going to invest in rare earths, you need to invest in large, high-grade deposits with simple metallurgy, and you need to invest in deposits that have access to processing chains, most of which are in China.
Right. That makes sense. To pivot toward uranium, uranium kind of had its moment in the spotlight recently. Where does your thesis stand today on the uranium market?
I think it depends on how patient you are. There are structural changes in the uranium market that are extremely beneficial. Having said that, the stocks are up spectacularly, truly spectacularly. Again, you have 150 companies in the sector, 11 or 12 of which are viable. And when I say that the stocks are all up, there's a bunch of little stocks that have gone nowhere because they deserve to go nowhere because they're exploring for uranium. They don't have any uranium. And if the price of something that you don't have goes up, it shouldn't impact your value very much. So people need to understand that caveat first. But a whole bunch has changed in the uranium market. First of all, we have and have had for some time a structural deficit, which is to say we're using more uranium than we're producing. Secondly, in terms of the above ground inventories, which the World Nuclear Association describes as adequate, they need to understand that 40% of the above ground inventories are held by Sprott through the Sprott Physical Uranium Trust. And that uranium isn't for sale. So the inventories are much smaller than the inventories that the industry believes. The third thing is that for the last 20 years, the spot market has been a reasonably reliable place to buy cheap uranium for the utilities. But that's changing too. The spot market is very, very thin, and the transactions are taking place in the term market. And that by itself is useful to understand for two reasons. The first is that 2026 term prices are substantially higher than the spot prices. That suggests that utilities are willing to pay more now for securing supplies in the future, which is to say the spot market is illusory. It's also important because uranium is the only commodity in the world that isn't subject to the vagaries of the spot market. Producers and consumers can enter into contracts with 20 or 30-year durations, meaning that in the uranium business, a producer can tell you how much they're going to produce and what they're going to be able to sell it for as much as 20 years from now, a circumstance that occurs in no other commodity. Over time, this certainty will lower the cost of capital, both debt and equity, and facilitate the acquisition of capital by junior companies that otherwise would have had to sell their deposits to put them in production. A profound change.
Wow, yeah, that is fascinating. That structural change in uranium. Now, I'm curious. You've described yourself as a speculator more so than an investor, And you mean that in a precise way. Most of us use those words interchangeably. So can you explain kind of the distinction between the two?
Let's start by saying I'm 73 years of age, so I'm more investment oriented than I was when I was younger. My wife would laugh and say all of the money that Rick now invests conservatively, he made by speculating aggressively, and that's true. Let's explore the difference between the two. I regard investment as an activity that you engage in to to earn with probability a reasonable return on capital employed. Speculation is different. That's an activity where you uh, take a chance on the possibility as opposed to a probability that you will earn above average returns. Uh, Speculation requires a tolerance for loss. It requires a tolerance for volatility, which is different than loss. It involves having both the psychological and the financial wherewithal to uh, accept bad time preference, which is to say it can take a long time. And you must absolutely psychologically and financially have the ability to withstand often, with regards to an individual position, 100% loss, but frequently a 30% loss. Many people are not psychologically equipped to speculate. After 54 years of speculating, I am. But the simple fact of my age, 73 years of age, and the amount of capital that I have to slash get to allocate today means I become more inclined towards investment than speculation. At the Rural Classroom, one of my functions, I teach speculation.
Yeah, that's amazing. And there are a lot of parallels there, kind of the flip side of the coin with what you're describing with patience and having a stomach for volatility. Whereas, in trading, sometimes it's being able to act with a very short time preference, but still dealing with volatility. So you've obviously, as you pointed out, you've been doing this for decades, hundreds of private placements at resource companies. Um, you've probably been to more investment conferences than some people have even had hot meals at this point in your career. So, my question is, given that, uh, what still kind of excites you or gets you up in the morning when you're looking at a resource deal or an investment?
I like the process. Uh, I really truly like the process. I was taught by a mentor early in my career, the great value investor Peter Cundall, that you outcompete others by liking what you do. They show up to work for the money, and you show up to work because you love to work. He said specifically, do something that you would otherwise do for free if it didn't pay so well, and then make sure you get paid. If you define work as a vaguely unpleasant thing that you do to sustain your life, I haven't worked a day in my life. I've been lucky enough to be involved with people and involved in an industry that's endlessly fascinating for me. Some people enjoy backgammon. Some really smart people on computers enjoy three-dimensional backgammon. I'm not that smart. So for me, I enjoy investing and speculating. I enjoy the process. I enjoy the people. Yes, I enjoy the money too.
Of course, of course. No, that's a great nugget of wisdom. Over the years, you've also, think fairly or unfairly, you have built a reputation for being willing to stick your neck out and say things that aren't necessarily what everyone else is thinking, right? Um, at times, has that ever cost you opportunities or deals or relationships throughout your investing career?
All the time. Uh, in as an example, in exploration, I want specific expertise, which is to say, if somebody is exploring for copper in uh, the South American Cordilleran, I want the management team to have experience doing just exactly that. That's a very, very inconvenient statement for someone that's trying to raise money to explore for copper in Peru that doesn't have specific experience. I've noted, however, that when I generate a lot of hate online, I know I'm doing the right thing. Uh, it's just something I've experienced. The other thing along that same vein that I'd like your listeners to consider is in capital intensive cyclical businesses like natural resources. the commodities and the companies and the sectors switch from wildly overbought to wildly oversold. Specifically in capital-intensive cyclical businesses, if you aren't a contrarian, you're going to be a victim. If momentum is what matters to you, and you are not an extremely skilled seller, you're gonna get killed. You have to be in sectors that are hated, that are out of favor, that are cheap. And when your narrative has been justified by the price action, you need to be smart enough to take the money off the table. I like to describe myself as a guy who buys hate and sells love. Um, or put perhaps more charitably, as I said at the onset, you are either a contrarian or you are going to become a victim.
That makes perfect sense. And we can think of many applications even beyond a capital intensive cyclical industry where, yeah, when something is hated, that's usually a sign. Um, that's a kind of a buy signal, right? In a lot of situations. So I have one more question, and then we can kind of wrap up with talking about the Rule Symposium and some of your other services. But you've worked on with companies on 6 different continents, from Canada, Australia, you mentioned Peru, Chile, Sweden, Switzerland. The list is sort of endless. Given that's the case, I'm sure there are differences between different jurisdictions, but is there any that come to mind that have kind of surprised you the most, whether positive or negatively, in how their companies operated?
Well, one controversial place that treated me extremely well and then very poorly was Russia. I was an investor in Russia for 24 glorious years, and then one year it all went wrong. So I experienced, again, in movie parlance, the good, the bad, and the ugly in one country in 2.5 decades. I would say the country that's treated me the best in 40 years has been Chile. The last few years have been rough. The voters, mercifully, I think, thanked and excused the socialists in Chile, and I think it will return, at least in extractive industries, into good graces. I hope that the recent political gains enjoyed by the people of Argentina continue. Wonderful natural resource endowment in Argentina. Wonderful place to hang out. What I've actually found is I need 2 things in a country. I need a good mineral endowment. You can't make money in minerals without minerals. But I also need friends. I need people in those countries who I know and love and trust, who can provide the local color that allows me to make money in that jurisdiction. I have friends in Chile, as an example, uh, who I have done business with, and had dinner with for 40 years. I can mention the name of a prominent Chilean who I'm thinking about doing business with, and they can either subtly say, "Yes, this person is good," or, "No, this person's bad. Stay away." So for me, a lot of it is what people of my generation would call a Rolodex, what people in your generation call contacts.
Yep. Same idea, but different terminology. Um, that's very, very insightful. So also, Rick, where else could our viewers find some of your work and services elsewhere on the internet or otherwise?
4 places, actually. Uh, the first is the most common. Anybody who has a natural resource portfolio and they'd like to know my opinion on it can go to one of my websites, ruleinvestmentmedia.com. If you list your natural resource stocks, I personally will rank them for free, 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. Sidebar, I'm an old guy. No tech stocks, no pot stocks, no crypto, just natural resource stocks. Let me do what I know how to do. The second thing is Rule Classroom, where I and others teach folks how to invest and speculate in natural resource investments. Ruleclassroom.com. All told, over 300 hours of instructional programming, including, when I'm in town, weekly Q&A sessions online for free. Ruleclassroom.com. Once a year for 30 years, we put on the Natural Resources Investment Symposium. After 30 years, we've probably done something right. This year's conference, July 6th through 10, is in Boca Raton, Florida, but the live conference is sold out. The only tickets left are online. You can join 3,000 other people from 30 countries online, July 6 through 10, unlike any other investment conference in the world that I know of. If for any reason you don't think you got your money's worth, no questions asked, we'll give you your money back. But there's a note. We're going to give you 46 hours of programming in 4 days. On top of that, we're going to give you access to the recordings, and you're going to need it because there's no human in the world that is capable of processing that 46 hours of intense programming in 4 days, meaning that don't budget 4 days. Budget 8 days or 10 days, including playing the tapes. This is for serious resource investors and speculators. If you buy the Sunday papers for the funnies and the crossword puzzle, don't attend the conference. If you are interested in working hard and obtaining the knowledge now that you need to invest and speculate in resources over the next decade, do attend the conference. The Rural Natural Resources Investment Symposium in Boca Raton, Florida, or rather, via live stream in the comfort and convenience of your own home, July 6 through 10, and then for another year in terms of the recordings. One final
Amazing. Oh,
I should
oh,
say,
go ahead.
you can see I'm a NASCAR driver. You can see who owns me, Battle Bank. Uh, uh, this is now my 7th bank. If any of your listeners are unhappy with their current bank, I suspect that's all your listeners. Check out battlebank.com. Particularly useful for people who would like to save in more than one currency. We offer banking products in 20 currencies, which I think will be helpful in the next 10 years. Also, if you're interested in getting paid interest, there's $3 trillion on deposit with U.S. banks that doesn't bear interest, particularly in people's checking accounts. If you're interested in interest, check out Battle Bank. Finally, if you own gold, silver, or platinum and palladium, but you need to access the capital without selling it and paying the capital gains tax, if you deposit that metal with Battle Bank, we can establish a metals equity line of credit against that metal. You can access the capital you have in your precious metals at relatively low interest rates without having to sell your stack. Battlebank.com.
That is excellent and a lot of great resources, no pun intended, that you just shared there. So, Rick, thank you for the conversation, and we look forward to having you back on Verified Market Insiders again sometime in the future.
I look forward to the invitation. Thank you.
Excellent. All right. Well, thank you for watching this episode. Be sure to check us out again next week for our next episode of Verified Market Insiders.